For decades, the message sold to Americans was straightforward. Purchase a home, secure a mortgage, steadily build equity, and eventually you could say you owned it outright. That was the promise. Yet in 2026, that story is being tested in a very uncomfortable way. Even when the loan is finally paid off, the tax obligation continues year after year. It doesn't care if your salary increases or stalls, and it doesn't change just because your property value moves up or down. All over the country, property taxes are beginning to feel like a permanent second mortgage, one that never truly disappears. The news tends to focus on soaring home prices. Mortgage rates spark fear. Insurance premiums create frustration. But property taxes often slip under the radar, even though they can weigh just as heavily. A new assessment in one neighborhood, a school funding vote in another, a county-wide increase, a bond issue, or pension-related costs can quietly raise the bill. Before long, the home that once symbolized stability can start to feel financially overwhelming. Local governments rely on revenue to fund schools, maintain roads, support public safety, cover pensions, and manage existing debt. When expenses rise, homeowners are frequently the primary source of additional funds. In some regions, rapid increases in home values have triggered reassessments that catch families off guard. In others, taxes were already high, and expanding budgets are pushing them even further. And in places where housing prices are beginning to cool, tax bills often continue moving upward anyway. In this countdown, we're looking at the 10 U.S. states where property taxes could surge in 2026. For many households, the next financial shock related to housing may not come from a lender. It could arrive in the mailbox instead. Number 10. North Carolina. We start with North Carolina, a state that many people still associate with affordability. For a long time, it was a major destination for Americans relocating from places like New York, New Jersey, California, Maryland, Virginia, and other nearby states. They were searching for a smoother transition, lower taxes, more reasonable housing prices, warmer weather, and an overall improved lifestyle. Cities such as Charlotte expanded rapidly. Raleigh experienced explosive growth. Asheville became a popular mountain living hotspot. Wilmington attracted retirees and remote workers alike. Even smaller counties that once felt quiet and steady suddenly faced levels of demand they had never experienced before. However, that rapid expansion brought an unexpected side effect. As home values climbed, reassessments naturally followed. And this is where North Carolina's situation becomes challenging. In many counties, homeowners are realizing that the very appreciation they once celebrated can return in the form of a higher tax bill. A property that gained significant value on paper can suddenly cost much more to maintain each year. The impact is especially tough for retirees living on fixed incomes, long-term homeowners, and families who purchased their homes before the boom and never anticipated taxes tied to today's hotter market conditions. The issue has become serious enough to reach the political stage. State lawmakers have discussed possible limits or adjustments to revaluation increases, as residents report increasing strain from rising assessed values. When conversations shift toward slowing or freezing reassessments, it signals that the pressure is no longer abstract. It is already affecting everyday households. North Carolina does not have to become the nation's highest tax state for residents to feel the consequences. The real strain comes from the difference between expectations and reality. Population growth requires more schools. New housing developments demand additional roads. Increased traffic calls for expanded infrastructure. Rising demand pushes property values upward. Once those higher values move through the tax system, the affordability narrative begins to weaken. North Carolina may still appear less expensive than many northeastern states, but for countless residents, the comparison isn't between Raleigh and New Jersey. It's between their current tax bill and the version of North Carolina they believed they were moving into. Number 9. Georgia. Georgia ranks ninth on the list because it positioned itself as a business-friendly and relatively low-cost option compared to more expensive coastal states. For years, that strategy worked. Atlanta evolved into a powerful hub for corporate headquarters, logistics companies, finance firms, film production, healthcare systems, universities, and technology employers. Suburban areas expanded rapidly as well, feeding the broader economic momentum. The development spread outward in all directions. Counties such as Gwinnett, Cobb, Cherokee, Forsyth, Henry, and Paulding, once considered distant suburbs, gradually became integral parts of the metro area's growth engine. What used to feel quiet and residential turned into active, high-demand communities. But expansion always comes with expenses. More residents mean more schools to build or enlarge, more roads to widen, upgraded water and utility systems, additional public safety staffing, and expanding municipal services. To cover those rising costs, local governments increasingly rely on property tax revenue. In 2026, many Georgia homeowners find themselves balancing two competing realities. On one hand, they want relief from higher bills. On the other, counties, cities, and school districts still need steady funding to function. The financial burden of growth often ends up being felt right at the homeowner's doorstep. State leaders have discussed broad property tax relief measures and longer-term strategies to ease the pressure on homeowners. However, reducing property taxes in one form does not eliminate government expenses. It simply shifts where the revenue comes from. The shortfall could be addressed through higher sales taxes, increased service fees, alternative local charges, or spending reductions. Until those trade-offs are clearly defined, homeowners remain caught in the middle. In rapidly expanding Georgia counties, property assessments can climb quickly as market conditions change. A modest home in what was once an affordable suburb may now be located in a district with rising demand, new development projects, and costly infrastructure upgrades. As a result, even residents who never moved can see their tax bills rise because the surrounding area has grown more valuable. Georgia's challenge isn't only about high taxation levels, it's also about volatility, sudden changes in assessed values that create financial shocks. Many people move there specifically for affordability, yet the same migration driving growth is also increasing the cost of local government. When a state known for lower costs begins losing that advantage, the housing market responds. Buyers become more cautious, investors feel less urgency, families tighten their budgets, and longtime residents start questioning whether the growth they once welcomed is now pushing them out through rising tax obligations. Number 8. Colorado. Colorado illustrates how a highly desirable state can gradually turn into intense property tax pressure. For many years, it ranked among the country's top lifestyle destinations. The combination of mountain scenery, outdoor recreation, a strong labor market, and steady economic growth made it extremely attractive. Cities like Denver expanded quickly, Boulder became associated with wealth and innovation, Fort Collins maintained stability, Colorado Springs gained momentum, and resort communities attracted significant investment. Nationally, Colorado built a reputation that convinced many buyers that purchasing property there was a solid long-term decision. However, that popularity created a serious side effect. Home prices rose at such a rapid pace that many residents were taken aback when the tax system adjusted to reflect those higher values. As assessments caught up with the market, the financial impact became more visible and, for some households, more difficult to manage. Colorado has already experienced heated debates over property tax relief, assessment methods, local revenue needs, and how to balance homeowner protection with funding for schools and essential public services. When property values surge, residents often seek safeguards. At the same time, when government expenses increase, local authorities look for stable revenue sources. Colorado finds itself positioned between these competing pressures. In certain areas, homeowners face more than just higher tax bills. Insurance premiums have increased, wildfire risks remain a concern, water resources are under strain, and overall living costs continue to rise. The property tax statement doesn't exist in isolation. It arrives alongside every other expense. For many residents, the sequence feels overwhelming. Mortgage payments, insurance premiums, utility costs, HOA fees, and then property taxes. Layered together, the overall cost of living can make the Colorado lifestyle feel heavier than marketing materials once suggested. One of the key risks in Colorado is what could be called a reset effect. New buyers entering the market after years of appreciation may encounter a very different tax structure than long-term owners anticipated. In higher-priced counties, even a modest tax rate applied to a very valuable home can produce a substantial annual bill. That reality can influence demand, because buyers evaluate not only the purchase price but also the total cost of ownership over time. Colorado remains highly attractive, and desirability itself isn't the issue. The challenge is that strong demand helped build a large tax base, which now plays a role in testing affordability. As households in 2026 grow more cautious with their finances, the full cost of owning property can shift from a background concern to a deciding factor. Colorado is not experiencing decline. It is experiencing the rising expense that often accompanies success. Number 7. Michigan. Michigan might not immediately come to mind when people think about property tax pressure, especially compared to states like New Jersey, Illinois, or Texas. However, it has a unique system feature that can catch buyers off guard. That feature is known as uncapping. For homeowners who stay in their property for many years, annual increases in taxable value are restricted while they remain in place. This system can provide meaningful stability and protection for long-term residents. But when the home changes hands, the taxable value can be recalculated and brought much closer to the current market value. That adjustment can significantly increase the tax bill for the new owner. In 2026, Michigan's concern isn't that every homeowner faces the same sudden increase. The real issue is that new buyers may believe they understand the ongoing costs of a property, only to find out that the previous owner's tax history does not reflect what they themselves will owe. The transition can create a sharp financial difference. This dynamic is especially relevant in places such as Grand Rapids, Ann Arbor, the Metro Detroit suburbs, Traverse City, and other communities where home prices have risen substantially compared to older assessment levels. A seller may have lived in the home for 2 decades, benefiting from gradual taxable value growth. Their annual tax bill might appear reasonable, but the buyer isn't purchasing that past tax structure. They are stepping into today's assessed value environment. When that reset occurs, the overall affordability equation can shift very quickly. The result is an unusual market effect. Long-term owners may feel encouraged to remain in place, since selling could mean losing their favorable tax base. Meanwhile, new buyers enter at the reset level, facing higher costs from the beginning. That can tighten inventory, slow down move-up decisions, and increase financial pressure on young families. At the same time, local governments still require steady revenue to fund services. Michigan's property tax challenges are not always visible through dramatic statewide rate hikes. Instead, the impact often shows up at the household level. This is particularly true for people relocating from other states who estimate their payments based on the listing price but don't fully anticipate how significantly the tax amount can change after closing. The surprise often comes after the excitement. A buyer finds the right home, secures the deal, completes the purchase, and then receives the updated tax notice. At that point, the monthly budget may feel tighter than expected. In 2026, with many households already balancing higher interest rates, rising insurance premiums, and broader inflation, an unexpected tax increase can quickly soften demand and reshape buyer confidence. Number 6. Florida. Florida ranks 6th because property taxes there are increasingly tied to a broader affordability challenge. For years, the state marketed itself as the premier tax-friendly destination. With no state income tax, abundant sunshine, beaches, retirement communities, and steady suburban development, it became a dream location, especially for people relocating from the Northeast and Midwest. However, many newcomers eventually discovered that the absence of a state income tax doesn't automatically translate into lower overall living costs. Instead, government funding has to come from other sources. In Florida, that pressure is now appearing through higher property taxes, rising insurance premiums, various fees, and special assessments. The state does offer protections for long-term primary residents, including assessment limits under the Save Our Homes framework. While that protection can be valuable for established homeowners, it also creates a noticeable gap between longtime owners and new buyers. If someone has lived in their home for many years, their taxable value may remain significantly limited. But when a property is purchased today, the assessed value can reset much closer to current market levels. That reset effect has become particularly impactful in areas where home values surged during the pandemic. Regions such as South Florida, Tampa Bay, Orlando's suburbs, Naples, Sarasota, Port St. Lucie, Palm Coast, and Cape Coral experienced rapid appreciation. In many of these communities, buyers aren't just paying elevated purchase prices, they are stepping into a new tax structure that reflects today's higher valuations. Florida faces an additional challenge: insurance. When insurance premiums rise at the same time property taxes are recalculated upward, the combined monthly housing payment can increase sharply. A home may appear affordable based on its listing price alone, but the full cost of ownership can tell a very different story once taxes and insurance are factored in. In certain cities, new homeowners can end up with substantially higher tax bills than longtime residents living in comparable homes, simply because the tax base resets after a sale. That difference influences how people think about buying. Purchasers may grow more cautious. Condominium investments can become harder to justify. Retirees may reassess their budgets, and investors may demand deeper discounts. Even families who relocated to Florida to reduce their tax burden elsewhere may find that the overall equation isn't as straightforward as they expected. Florida's primary risk isn't uniform tax increases for everyone. Rather, it lies in the possibility that incoming buyers face costs high enough to soften demand. And when demand begins to cool, the broader housing market must adjust accordingly. Number 5. Texas. Texas takes the 5th spot because it is widely known as a no-state income tax state, yet property taxes there can feel like an additional mortgage payment. For years, the state promoted a clear message: no income tax, a business-friendly environment, large homes, spacious lots, and rapidly expanding cities. Austin, Dallas, Fort Worth, Houston, and San Antonio all experienced strong growth, with suburbs spreading outward in every direction. At first, many buyers were willing to accept higher property taxes because home prices were generally lower than those in places like California or New York. That trade-off made sense for a time. However, after the pandemic-driven housing surge, the balance shifted. Home values rose sharply, assessments increased, school districts required more funding, infrastructure expenses expanded, and the simplicity of the no-income tax advantage began to fade. Texas homeowners frequently voice concerns about property taxes, and those concerns are understandable. The total bill often includes contributions not just to cities, but also to school districts, counties, hospital districts, and various special districts. Even when state leaders introduce tax relief measures, many residents still feel pressure because property values have climbed so significantly. When assessments rise, the overall tax burden can still increase in absolute terms. Over the years, Texas has attempted to lower school tax rates and expand homestead exemptions to ease the strain on homeowners. Despite these efforts, growth continues to generate new expenses. Expanding populations require additional classrooms, road construction, police and fire services, water systems, drainage improvements, and management of public debt. In a system where local governments depend heavily on property taxes, rapid development inevitably shows up in household tax statements. The effect is especially noticeable in suburban areas. Communities surrounding Austin, Dallas, Fort Worth, Houston, and San Antonio attracted families seeking larger homes and more affordable living. But those same suburbs now face the costs of new school construction, bond initiatives, utility upgrades, and rapidly changing property values. A homeowner who purchased a new construction property expecting stable long-term expenses may discover that the initial tax estimate at closing was only the starting point. Another risk emerges when home prices begin to level off. If property values stop rising but tax bills remain high, buyers may become less willing to stretch their budgets. That can weaken resale demand, particularly in outer suburbs where monthly payments already include long commutes, higher interest rates, and substantial tax obligations. Texas remains a major economic force, dynamic, fast-growing, and influential. However, its affordability narrative is facing increasing scrutiny. When a state offers no income tax, but combines it with rising property tax bills, the overall value proposition starts to look different. What once felt like a clear financial advantage can become more complex for today's buyers. Number 4. New York. New York ranks 4th because property taxes are already substantial, and in several regions the financial strain can become especially intense. When people think about taxes in New York, their attention often goes to state or city income taxes. However, property taxes represent one of the state's most significant affordability challenges, particularly in suburban counties and many upstate school districts. Areas such as Westchester, Nassau, Suffolk, Rockland, Putnam, Dutchess, portions of the Hudson Valley, and numerous upstate communities can illustrate this issue clearly. In many of these locations, home prices may not appear extreme at first glance, Yet the annual tax bills can be strikingly high relative to local incomes. That mismatch is what makes the situation feel so difficult. Importantly, this pressure doesn't only affect owners of large or luxury properties. In many cases, it is middle-class families living in ordinary homes who experience the impact most directly. When school district taxes, county levies, town and village charges, and special district assessments are combined, the total can transform homeownership into an ongoing financial challenge. In 2026, the situation becomes even more sensitive because local governments are confronting the same rising expenses seen elsewhere. Labor costs, construction expenses, pension obligations, school funding needs, public safety budgets, debt payments, and infrastructure maintenance all continue to grow. In many communities, population growth is not strong enough to offset these increasing costs, which means the financial load may fall more heavily on existing homeowners. New York also experiences ongoing debates around high-value properties, including second homes, luxury residences, and vacant properties in certain regions. When officials consider these properties as potential revenue sources, it reflects broader budget pressure. Governments under strain tend to search for funding wherever it can be found. From a housing perspective, tax expectations influence decisions long before contracts are signed. A home in a scenic Hudson Valley town might seem appealing to someone relocating from the city. But once the property tax estimate is reviewed, the overall affordability picture can change significantly. A Long Island buyer might already be managing high mortgage rates and insurance costs. Adding substantial property taxes can push monthly payments to uncomfortable levels. In upstate communities, some homes may not be particularly expensive in market terms, yet the tax burden can feel disproportionate compared to local wages. That is the core issue in New York. The property tax system does not only affect luxury properties, it impacts everyday households. And in 2026, when basic living expenses are already elevated, additional tax pressure can make financial stability even harder to maintain. Number 3. Connecticut places third on the list because it blends high property taxes with costly public services, aging infrastructure, and constant local budget strain. In this state, property taxes aren't just one piece of the financial puzzle. They are a major driver of overall living costs. Homeowners across Connecticut are well aware that tax burdens are among the highest in the nation. A property might seem reasonably priced when compared with parts of Westchester County or New York City, but once the annual tax bill arrives, that apparent advantage can quickly disappear. This is particularly evident in communities with strong school systems, older infrastructure that requires ongoing maintenance, and heavy dependence on local property tax revenue to fund operations. While Fairfield County often draws the most attention, the pressure extends far beyond it. Suburbs around Hartford, towns in New Haven County, smaller municipalities striving to support their schools, and areas undergoing property revaluations all experience tight budgets with limited flexibility. In many of these places, local finances leave very little room for unexpected expenses. By 2026, numerous municipal budgets are being squeezed simultaneously. Education costs continue to rise, labor contracts are expensive, existing debt obligations must still be paid, public safety spending keeps increasing, and many taxpayers are already feeling financially stretched. This combination can create a difficult cycle. Residents want reliable services. Local governments require stable revenue. Homeowners resist additional increases. Yet expenses continue climbing. In several Connecticut towns, budget discussions increasingly revolve around mill rates, school funding allocations, vehicle taxes, and debates about whether households can handle another hike. Connecticut is not a state where property taxes begin at a low baseline. In many communities, the starting point is already high. As a result, any further increase is felt more intensely because it builds on an already substantial burden. For retirees, rising taxes can become a reason to relocate. For younger families, high carrying costs may discourage purchasing altogether. Sellers may notice a smaller pool of potential buyers. In some towns, this dynamic can slowly create pressure that encourages long-term residents, especially those who can move more easily, to explore other options. The challenge in Connecticut isn't simply the absolute amount owed each year. It is the ongoing sense that the tax obligation consistently weighs on household budgets. In a state that has long faced affordability concerns, Property taxes are one of the clearest and most immediate ways residents experience financial strain. Number 2. Illinois. Illinois ranks second because property taxes are one of the main factors pushing homeowners to reconsider whether staying is financially sustainable. For many years, the state has been known for having some of the highest property tax levels in the United States. In many areas, especially Chicago and its surrounding suburbs, the annual tax bill isn't just another expense. It is one of the central costs of homeownership. The issue is complex and layered. Local budgets must cover school systems, municipal operations, pension obligations, county services, public safety, infrastructure upkeep, and public debt. At the same time, in many communities, population growth has been relatively slow, which means fewer new taxpayers are available to spread out these costs. As a result, the financial burden falls more heavily on existing homeowners. This is one of the reasons property taxes in Illinois often feel so persistent and difficult to escape. Even when home values remain relatively stable, tax bills can stay high. Even when neighborhoods don't appear to be rapidly growing or changing, the underlying costs of local government still need to be funded. When reassessments occur, the resulting increases can feel especially abrupt. Illinois also faces a perception challenge that affects buyer behavior. Many prospective homeowners are already aware of the state's reputation for high property taxes, and that awareness shapes their decisions before they even start house hunting. A property that looks affordable on the surface may become significantly less attractive once taxes are included in the calculation, which can weaken overall demand. This effect is particularly noticeable in middle-class suburban markets. A buyer might compare a home in Illinois with similar properties in states like Indiana, Wisconsin, Tennessee, North Carolina, or Texas. At first glance, Illinois may appear to offer more space or better value. But once property taxes are factored into the monthly cost, the financial advantage can quickly disappear. For long-term residents, the issue often becomes deeply personal. Many have already paid off their mortgages, raised families in their homes, and hope to remain there through retirement. However, even without a mortgage, the ongoing tax bill continues to arrive. When those costs rise faster than income, the sense of financial security begins to erode. That is the core reality of property taxes in Illinois. Full ownership of a home does not necessarily mean freedom from financial pressure. In 2026, with high interest rates, rising insurance costs, and already stretched affordability, property taxes may play an even larger role in discouraging buyers and prompting some homeowners to consider leaving the state. Number 1. New Jersey. If there is one state where property taxes are already infamous and still at risk of becoming even more burdensome, it is New Jersey. For decades, New Jersey has stood as the clearest example of America's property tax pressure. Not because homeowners don't understand where the money goes. They do. It funds schools, police, fire services, local government, dense infrastructure, and a wide range of public services in some of the most established and high-expectation communities in the country. The system is complex, the municipalities are numerous, and the cost of maintaining everything is high. But even when the reasoning is clear, the financial reality doesn't get easier. Homeowners in New Jersey regularly face tax bills that would feel extreme in many other states. And in 2026, that pressure shows no sign of easing. School districts remain expensive to operate, local governments continue to require funding, public sector costs stay elevated, infrastructure is aging, insurance premiums are rising, and home prices, while sometimes cooling, still sit at high levels in many areas. Crucially, even when the housing market slows, government funding needs do not slow with it. That creates a particularly difficult situation. A homeowner may see fewer bidding wars, softer appreciation, or even a cooling market, yet their property tax bill can still climb. Over time, that disconnect turns frustration into real financial strain. New Jersey is also unique because property taxes influence nearly every housing decision. Buyers don't just evaluate whether they can afford a house, they evaluate whether they can afford the town itself. They compare school district costs, calculate whether moving one county over offers relief, and even question whether retiring in the state makes long-term financial sense. For many, the conclusion is that it does not. This dynamic has contributed to ongoing out-migration pressure. New Jersey still offers strong incomes, highly rated schools, close access to New York City and Philadelphia, and some of the most developed suburban infrastructure in the country. but it also demonstrates how sustained tax burdens can weaken housing confidence over time. A home that looks attractive on paper becomes harder to justify when the annual carrying cost is fully understood. Retirees are more likely to relocate when taxes keep rising. Young families increasingly look to states like Pennsylvania, Delaware, North Carolina, or Florida, where the monthly equation can feel more manageable. And for those who stay, the tax bill can feel like a permanent, unavoidable obligation. The reality in New Jersey is not subtle or hidden. It is visible in everyday life. Property taxes are not a distant concern or a theoretical debate. They are an ongoing household expense that shapes decisions year after year. And in 2026, if local costs continue to rise while homeowners absorb the difference, New Jersey will remain the clearest example of a state where owning a home does not remove financial pressure. It guarantees you will keep facing it every single year.